Hi everyone, in this video we're going to be walking through our Chapter 1 homework problems, and hopefully this will help you as you work through and solve. Okay, so we start with problem number 1 here, and it provides us some information. It says, consider the following information of John Bonham. It says cash, furniture, automobile, house, credit card, bank loan, and mortgage. And then it has balances for each of those types of accounts, essentially. And so what we're required to do below that is to calculate total assets, total liabilities, and total net worth. So in order to do this, we need to be able to classify the specific amounts above and those accounts that those are associated with into those categories of asset, liability, and then net worth. And we also kind of need to understand the fundamental accounting equation, which I will write in here just to have it so we can see. It is assets equal liabilities plus net worth. And you don't need to write that in on your copy necessarily. You're just going to put the answers in, but I wanted to put that up on the screen for us. If you'd like to write that out, feel free. It's never bad to have more reminders of what that equation is. As it is very important for accounting overall. Okay, so let's get started here, identifying the types of accounts that we have above. If you'll remember from the lecture video or other discussions in class, assets are things that we own, whereas liabilities are things that we owe, debts, if you will. And then if we take our assets minus our liabilities, if we were to do a little bit of algebra on this equation, assets minus liabilities, that would equal our net worth. So in other words, if we had liquidated all of our assets, we sold them all, and then we paid off all of our debts, what is left over would be the net worth. And that will come into play down here when we finish our problem below. Okay, so let's get started just going line by line. And I'm going to put some notes next to these so you can hopefully understand a little better and follow along as we complete the problem. So the first consideration here is cash. So that is an asset. So we'll note that. The second consideration is furniture. That's something that we own again. So it is also an asset. Same thing with an automobile. It is an asset. A house is an asset. Now, when it comes to a credit card, think of that again as debt or something that you owe. It's not something that you own. It's an obligation to make a future payment, and so we call that a liability. I spelled that wrong. Liability. And then similarly, the bank loan, that's money that we owe to the bank, so it is also a liability. And finally, a mortgage is a loan taken out to purchase real estate, house loan, typically, from a personal finance perspective. And again, that's money that you would owe to a lender, a bank, etc. And so that is a liability as well. Okay, so now we're going to come down to our box here. And in terms of Excel work, I'll just, mention real quick, you've got your cursor, you can click into the different cells. And we're going to click into our answer spot here. We're going to do an enter sign. We're going to make a formula. And then we're going to go up here into our formula bar. I just kind of want to show you this. You can see where you start doing your formula. So we have equals. And then we're going to click each one of these cells and then input a plus sign between each cell that we select, with the result being that we are adding all of the totals of the assets. So this equals C5, which is this cell, plus C6, C7, C8. So we add those all together, and the sum of all of these amounts comes out to $99,200. Okay, perfect. Now let's do the same thing. We'll do equals, and we'll just select the three liabilities with plus signs between them, hit enter, and the sum of all the liability amounts comes out to $38,200. And then we're going to look up here to our fundamental accounting equations and say, okay, it doesn't tell us what net worth is here, but we know assets, we know liabilities, so now we can just take the difference between those. So we'll say equals assets minus liabilities, and that comes out to $61,000. And if we want to check ourselves now with this first equation here, which it doesn't specifically ask us, but I'll put another little formula off to the side. This amount for assets should equal our liabilities plus our net worth. So we know what assets are, $99,200. And then let's do a little formula here. We'll say total net worth plus liabilities, liabilities plus net worth. That's what we're going to calculate. Hit enter. And lo and behold, we get the same amount. And so we are in balance in our accounting equation balances. And that lets us know that our accounting records are accurate, essentially, at that point, or at least we're in balance. I don't want to say completely accurate, because you could still be in balance with some errors in the underlying records, but the essential accounting equation does equal here. Okay, perfect. Let's go on to problem number 2. So in homework problem number 2, it tells us that we have some information taken from personal records, and we call these opening balances. So this would be our starting balances, if you will, at a given month or a given accounting period, maybe a year. Here we're talking about a month. It says March 31st. So on March 31st, we've got opening balances we showed as $2,200 of cash, $1,400 of jewelry, $223,100 of the house cost, the value of that, or I should say the historical cost paid, the mortgage of $106,500, and net worth of $120,200. So this is our starting point, our opening balances for these assets for us. And let's just do real quickly a little note off to the side, just so we're understanding as we begin. Cash is an asset. Remember, jewelry is an asset. A house is an asset, but mortgage is a liability, and then net worth is net worth. So we should be in balance there with these numbers. And let's just test ourselves just to reinforce that concept. If we add up all of the assets, we get 226,000. We'll say total assets. And then we'll come down here and we will show we only have one liability, so it's that amount. And we've got one amount, for net worth here. And if we add those together, then you can see our accounting equation again holds out. 226,700 of total assets equals the same thing as liabilities plus net worth. And again, that was back to this original equation here, assets equal liabilities plus net worth. Okay, so let's get on to the required sections. There's some transactions that occurred during the month here that we're going to record. And what we want to do is use this thing called a T account. So you can kind of see it's shaped like a T. You've got a top line and a middle line here. And we're going to do increases and decreases to an account when we use a T account, we're going to do our increases. We're doing cash. This is the cash. It's an asset account. We're going to do increases on this side, decreases on this side of the T account, essentially. But let's start with our opening balance. So we can use Excel. Let's just link up to our beginning balance for cash, which told us it was $2,200. And then let's look at each one of these transactions. And we're just going to consider the impact on the cash account of these transactions, right? So the first transaction says that we earned a monthly salary of $5,970. And so that was an increase to cash of $5,970. So you can just go ahead and put that in. Transaction number 2, we paid $960 for travel expenses. And I'm going to do one little thing here. You'll see me if you want to do this as well. I'm going to format these using this little comma up on your Excel bar up here, and that puts it in the accounting format. We don't care about the decimal places, so then I'm going to click those two, but that will give us commas and make our numbers look a little more clean. Okay, so with that said, we paid $960 for travel expenses, so we're paying the cash now, so we're going to put it on the decrease side. We purchased an automobile worth $11,240, but we purchased that on account. And remember, on account is very important terminology here to understand, because that indicates that we have incurred a liability or additional debt to purchase this automobile. We did not pay cash yet for that. So the cash account is not going to be affected at this point because we purchased on account. We're not looking at the liability accounts, but if we were, we would see an increase there, not an impact on the cash account. Okay, so nothing to record for number 3. But let's come down to number 4. We paid $890 cash for food expenses. So that is a reduction of cash, so we'll put that in. Then we paid $310 for hydro. I'm not entirely sure what the book publisher was indicating with that, but it's just an expense, so we will leave that there. And actually, sorry, let me line these up just a little better. I realized I was just a little off there. So transaction number 2, we'll put that there. Then we will skip number 3 because we did not have a cash impact. It was purchased on account, or in other words, we incurred additional debt for that purchase of the vehicle, the automobile. But we did pay $890 cash for the food, and then $310. And now we want to come down to our ending balance of our cash account here. And so to calculate the ending balance, we want to take our beginning balance, or opening, same thing, opening balance, plus increases minus decreases. So we can do a formula for that. Let's do an equal sign. We select the opening balance, add the increase there, and then put a minus. And you can do minus the 960, minus the 890, minus 310. And what we see is that our ending cash balance now is $6,010, whereas it started with $2,200. And it just adjusted based on these transactions that occurred during the month. Okay, now part B asks us to complete the personal income statement to determine the surplus or deficit for the specific account here, or for the month ended in April, which is the month that corresponds to these transactions. And so when we talk about an income statement, what we're really going to be trying to dial in on is revenues and expenses. And so when we look above, first we need to identify revenues. And so we look through here, and revenues are earnings essentially. And so we see that we earned $5,970. So we'll put that in. Again, I'm going to do a formatting there. We'll click the accounting format. No decimal showing. So we had earnings of revenues of $5,970, and then we had these expenses we incurred. So we had, for food, we had $890. Hydro, $310. Travel expense is $960. So those are all listed above here in the transaction detail. And then we can come over here and we can do an equal sign. Let's add all 3 of these expenses together. Click enter, and that lets us know that our total expenses is $2,160. And then finally, to calculate our surplus, if we have a surplus of revenues over expenses, or a deficit if our expenses exceeded our revenue, to calculate that, we take our revenues minus expenses, and we have a positive number. So we have a surplus of $3,810. Great. And then let's come down to C. It says, what is Juliet Lamb's net worth on April 30th? We know the beginning balance of net worth, so we'll put an equal sign. And let's just look up here. I'm scrolling up. It was, and we can actually link to this as a cell, $120,200 to start. And then the surplus will increase our net worth. And so we just need to put a plus sign there. So again, it was our beginning balance or opening balance of net worth plus our surplus. It would be subtracting if it was a deficit, but it's adding to our net worth. And so our net worth now is $124,010. Again, that was our opening balance of net worth plus our surplus for the month. Okay. And that brings us to the end of problem number 2. All right, so homework problem number 3. So this specific problem asks us to consider net worth real directly. And so we are going to be looking at the fact that we have Lydia Kapoor. She has total assets here of $36,540, total liabilities of $20,540, and that is as of January 31st, 2023. And then 1 year later, at January 31st, 2024, we have assets of $38,740 and total liabilities of $18,630. So the first thing we want to do is to input net worth into the boxes at right. And we are going to put these in here, and we can do a formula to basically calculate this out. So when we were looking at problem number 1, remember, we determined that our net worth is the difference between our assets and our liabilities. So our formula that we want to input here to calculate net worth is just going to take our assets of $36,540 minus our liabilities of $20,540, and that gets us to $16,000. Again, I'm going to format these to make that a little cleaner there. Okay, and then similarly, as of January 31st, 2024, using this data, we have total assets of $38,740 minus $18,630, means that our net worth, our difference between our assets and our liabilities, has risen to from $16,000 to $20,110. So here it asks us, has it increased or decreased? So it has increased. And how much has it increased? Well, here we can just take the difference between the amounts at the two different times. So 20,110 minus 16,000 in our Excel formula. And we can say that net worth has increased $4,110 overall. And I'm just checking my math here, make sure I got these all in right. 38,740, 18,630, and we're looking good. Okay, perfect. Let's go on to number 4. Okay, so in number 4, we're going to start seeing additional T accounts. We looked at just the one cash T account back in, I think it's problem number 2. But now we have all of our assets listed in T account form, all of our liabilities. We have our net worth, we have revenue, expenses. So we kind of have everything from a financial perspective in T account form listed here in our T accounts on our spreadsheet. And we have opening balances, and then we have a number of different transactions. And so we're going to go through and do all of that activity tracking in our T account spreadsheet here and see what kind of surplus or deficit we get. And then when we get to the end of the problem, we're going to again want to compare and make sure that our total assets equal our total liabilities plus net worth. I have what's called a check figure in place here, kind of a self-check figure. And so this will tell us as we do our work whether or not we are in balance, and that essential accounting equation remains true. Okay, so let's begin by putting in our opening balances. I have already put in formulas into the spreadsheet, so most of the formulas are here for us, so we don't have to do too much of the additions and linking and things like that. We just need to input the balances into the T accounts. And we can do, actually one linking thing we can do, which is kind of handy, is we can link the cell here into the opening balance cells so that cash has an opening balance of 11,900. Contents of home has an opening balance of 2,100. Automobile, 18,500. House, 163,600. Unpaid accounts, liability of 6,800. Bank loan, 59,100. And it doesn't provide us with net worth. You see a hint down here for part A. We have to calculate the net worth opening balance. So let's put a formula in to do that. So our opening balance then will be the difference. Again, remember our kind of a fundamental accounting equation is that net worth is the difference between assets and liabilities. So we can add up all of our opening asset balances. So we've now got all of our assets added together. And then let's subtract out all of our liabilities. And that gets us 130,200. And we can see that our beginning balance now balances to zero. Our accounting equation is looking good. And now we can proceed with our transactions that occurred during the month. Okay, transaction number 1 says we paid miscellaneous expenses with $800 cash. So that's going to be a decrease to cash of $800. And then it's going to be an increase in miscellaneous expense of the $800. And keep in mind when we say an increase in expenses, that is going up, but overall that decreases our net worth because, and you can see that here, because expenses are a reduction to net worth. So as expenses go up, net worth goes down. Okay, transaction number 2 says we purchased new jewelry worth $2,500 cash. So we're going to again decrease cash, $2,500. We're going to put this into contents of home. That will be the account that we use to represent the increase in our jewelry expense, our jewelry asset purchase. Now we paid our credit card liability in full, so that means we paid this. That credit card liability is what is included here in the unpaid accounts account, and we are saying that we are paying this off. And so look here, a decrease for liabilities is opposite to the assets. So we want to decrease by putting 6,800. That reduces our ending balance there to zero. And the way that we pay down a debt, a credit card balance, etc., is by reducing cash because we made that payment. Okay, that was transaction number 3. So transaction number 4 says that we paid telephone, electricity, and water bill for October with $600 cash. So we're going to have cash reduce again. And now we're going to record utilities expense for $600. And note that telephone, electricity, and water, those are all utilities, and we can just group that into one expense account here. And we're still in balance, so that's looking good. Now number 5 says we purchased $2,400 of groceries and goods for personal consumption with cash. So we do one more cash decrease. And that brings us, let's see here, our food expenses, the account that we're going to use for recording that expense. And then we deposited $4,400 of salary. So that will be an increase to cash of $4,400. And we're going to record that as revenue here. And we're going to put that on the increase side. And as you can, so now let's take a look at our income statement, revenues minus expenses. Our total revenues, we just had the one deposit of salary of $4,400. This formula adds up all of the expenses together, which leaves us, which totals to $3,800. Taking the revenues less expenses, and here we use the word less to mean minus, essentially. So revenues minus expenses means that we had a surplus of $600. That goes into our net worth, which leaves us with $130,800. And then here we can see our ending total assets is $189,900. Ending total liabilities is $59,100. And net worth is $130,800. And you can see that our assets equal our liabilities plus net worth. Our check figure here is 0. And we've completed the problem. So as you can see, there are numbers of different T accounts you can use, like we looked at in problem number 2. That was just looking solely at this. But when we kind of zoom out and look at the whole financial position here in total, we have assets, liabilities, revenues, expenses, net worth, so on and so forth. And they have different increases and decreases of their T account, which side they go on. And I will also highlight here, we looked at this in number 2, but as a reminder, so when we're coming to get an ending balance like what these are for any one of the accounts, we need to take our opening balance plus our increases minus our decreases. So here our opening balance plus our increases is 16,300. All of our decreases add up to 13,100. And then the difference between those gives us our ending balance of 3,200. On the liabilities side, decreases are on the left. On the asset side, decreases are on the right. So that's something that you'll just get used to as we work through accounting problems. It's a little bit different than pluses and minuses maybe that you're used to, but we use more of a left-right kind of a designation in accounting to identify increases and decreases in accounts typically. Okay, let's take a quick look here and solve. All right, so in homework problem number 5, we've got our instructions over on this side here. Similar to problem number 4. We have opening balances again. This time we're provided with net worth. Remember in our last problem we had to calculate that to start, but here it is provided, so we can just input that directly. And so let's put our opening balances in now. We have cash, contents of home, automobile, house, unpaid accounts, mortgage, and finally net worth. A good first step is just to check and make sure that everything is in balance, and it is. We can see that total assets equal total liabilities plus net worth, so that is a good place to begin. Okay, so as we go through and analyze our transactions, let's take a look at number 1. So we purchased new jewelry worth $900 for our home using the credit card. Okay, so when we are using our credit card, we're not paying in cash yet. Eventually we'll pay that liability in the future, but at the time of purchase, we're using a credit card, so we're increasing our liabilities essentially, or the debt that we have. So we're going to include that in our unpaid accounts account, and the increase goes on the right. And then we're going to include $900 increase in contents of home to reflect the fact that this is an asset, the jewelry that we purchased. Number 2, we paid a credit card bill with $4,000 cash. So now we're going to impact the cash account. We're going to have a decrease of $4,000. And now we're reducing our credit card bill down to $8,000. Number 3, paid travel bills of $1,100 for the month using the credit card. So now the credit card amount is increasing, and that was travel expense. $1,100, sorry. So on the expenses, we have those increase on the left side of the T account. We purchased gas for $150 using cash in this instance. So cash goes down and our gas expense goes up. You can kind of glance over and make sure you don't make a typo by checking your figure here. And if this becomes something other than 0, and this little hash mark is 0, that is the 0 that comes in as shown when you have this accounting formatting selected. But that is a 0. It means we're still in balance, and that's great. Number 5, we made a principal payment of $900 on the mortgage. So a payment means that cash is decreasing. Principal payment, when we say principal, that means not interest. When you make a payment on a loan or a debt, sometimes you'll make a payment of, say, for example, $1,000. $900 might be principal, and then the other 100 is interest, because when someone like a bank or a financial institution loans you money, usually they charge you interest, and that's an expense that you incur, whereas the principal balance actually reduces the outstanding amount of that loan. So with that said, we're making a principal payment on the mortgage. There was no interest, that we're considering here. It's just principal. So that reduces our outstanding mortgage balance from $162,900 down to 162,000. All right, transaction 6, we paid January's rent of $1,300 with cash. So cash goes down, and rent expense, let's find our rent expense count there. That goes up $1,300. All right, and finally, I think we're on number 7. Yes, and we deposited $4,500 in salaries earned during the month. So that is our revenue. So remember, we want to be on the increase side for revenue. And we will check that there. And now you can see something has gone off with our revenue. And you'll notice that I just kind of wanted to highlight how this check figure will show variances, because we have not yet put the other side of the entry in yet, which is to show the cash received from that deposit. And once you go ahead and put that piece of it in, then our check figure goes back to 0. And that is, again, indicates that our assets equal our liabilities plus net worth, and our accounting equation is in balance. And we've got everything recorded for the month. Total assets, again, this formula is put into the spreadsheet here for you in this instance. But what it's doing is adding all of the ending balances in the asset accounts here. And then similarly with liabilities, it's adding the ending balances of liabilities, and net worth just comes from here. We increased net worth by $1,950 because our revenues of $4,500 exceeded our expenses of $2,550 by that amount. Okay, let's go on to problem number 6. So here in homework problem number 6, we've got Tom Petty. Apparently, they use some musician names in here, kind of funny. But he's a senior administrator, different Tom Petty apparently. And he received a salary increase from $5,500 to $6,000. He feels richer. He wants to know the increase in his net worth. So we're going to help him do some of that work and see how much his net worth is increasing. And this is going to be for a 3-month period, it looks like. Okay, so primarily what we just need to do is take this kind of disparate financial information above and organize it into the income statement. And remember, we've been looking at the income statement in these previous problems, and that is revenues minus expenses, essentially. So let's start with revenues. So we'll just do an equal sign and link to the cells above. And we're going to say salary. So it's a little bit hidden in the name, but salary is what you earn at a job. For personal finance, as we're talking about in chapter 1, that is a very common form of revenue that individuals will have. Okay, so that is this. I want to show you a little Excel trick or technique here. We want to pull in these next 2 cells because we want 5,500 here, 5,500 here, same amount, and then 6,000 here. If you double click in, that's how I'm getting in to see what's in the cells too. But what we want to do is to do our formula, instead of picking up here, we now want it to go here, and then we want it to go here. And so we can just drag this across. So if you put your cursor down in the bottom right corner, you see how it changes to a black cross there? Then you can hold down your selection button and drag it across. And that will change the formula to basically drag across and do the same thing it did originally, but it'll now pick up the information in those new cells to the right. Okay, and then we want to add the total of all the revenue. And I want to show you one thing that we could do equals this plus this plus this and hit enter. That's totally fine. But there is another way, this button called auto sum up here. It's a little bit of a faster way just to add numbers if they're right next to each other. So then it says sum parentheses, and it shows the C21, which is that cell, through E21. And then we can just hit enter, and it gives us the same information there. So that's great. Okay, now let's link to our other expenses. We have entertainment, we have food, we have insurance, and we have miscellaneous, and we have utilities. Okay, and now we really want to do the same thing like we did with the revenue, we just want to drag, we want to get these same numbers. So 530, next we want 460, then we want 450. So one easy way to do all of these at once, another little Excel technique, you're going to want to highlight all of those cells that you just linked. And then again, you come down to the bottom right, you see your cursor turned into a black cross kind of thing there. Then you hold the left mouse button down, and then you can drag that across, and it will automatically populate and pull that formula across to pull in those numbers to the right of your original formulas. And then again, we can come down and use our auto sum function. Click enter there to summarize those three amounts. So the food expense for our 3-month period was $14.40. And then finally, we can again drag that down just like we had been doing, and you'll get that same summation formula to be dragging across, and you'll have the answer nice and quick without having to type in 1 plus 1, doing individual summations. And then this formula was pre-input. Our total expenses just adds all of these up. And then our surplus or deficit is again our revenue minus expenses. You can see that for every month. So over the 3-month period that we are considering in June, July, and August, his total surplus is $8,090, and so his net worth will have increased by this amount over that time period. Tom Petty, I guess. Okay, problem number 7. Jeff Black is working at a law firm. His salary recently increased, so kind of a similar type of thing. We've got data here, and we want to track his net worth. And it tells us, assume the net worth on April 30 is 270. So we'll put that opening net worth here into the opening net worth box at the end of April 2024. And now we need to calculate his surplus or deficit. So we're just going to do this in one cell. So let's just put an equal sign. And so remember, the key thing we're working on with surplus deficit is that it is revenues minus expenses. So we're going to come up and grab his salary revenue. Remember, salary is his personal revenue. And we want to reduce all of the expenses. We need to find what expenses are, right? So cash, that's an asset. Automobiles are an asset. Bills are liabilities. Loans are liabilities. Credit card bills are liabilities. What we want here are expenses, and we found them down here. So let me fix this, sorry, equals the salary minus food expense minus entertainment expense minus rent expense. And when we do that, that gives us $6,460 for total increase to, it is the surplus, which is the increase to net worth. And we had a beginning or an opening balance here. So we just have to add these two together. Click enter, and you'll get 6,730 as your closing net worth. So opening was 270. Revenues minus expenses was a $6,460 surplus. Adding those two amounts together gets us a closing net worth of 6,730. And then one key idea to know in accounting is that we often are talking about accounting periods. So April, May, June, and these are all kind of blocks of time that we're considering financial information. And so the closing net worth, or also the closing assets or closing liabilities of a specific month, like April, then those become the opening balances of the following month of May, right? So it's just this ongoing cycle of one month ends, the next one begins, and what was the closing net worth of the month before becomes the opening of the current month, essentially. Now, because we learned our handy Excel technique, we can just drag that over. And remember, that'll take our salary minus food expense, entertainment, and rent. And our formula basically just does that. This is adding these two together, so we can also just drag that across. Helps us there. So then the only thing we're missing now is just the opening net worth for June, which is the closing net worth of May, the month before, and we can easily just do an equals. Whoop, sorry, a little. Yeah, there we go. Okay. I deleted that. Hit two keys at once. So now we have this closing becomes the opening of the next month, and then the surplus or deficit for that month here we calculated as $6,800 with our formulas. And when we add those together, opening plus the increase due to the surplus means we close out our net worth at $19,730. And that's great. Okay, let's take a look at problem number 8 here. Oh, you know, I think I need to. This title is a carryover. Let me delete that out. But I will fix that in the copy that you all will be able to see online when you download this Excel template. But what we are doing in this problem is going through, and we are going to be basically analyzing the impact of different transactions on the overall balance sheet here and the balance sheet accounts. And what those balance sheet accounts here are essentially the same accounts that we were talking about in that fundamental accounting equation. So we have assets, liabilities, and equity. Or, sorry, I should say net worth. I'm actually grabbing my answer to fix that. Okay, there we go. So now we're going to use the opening balance as provided, which is all this information, in a balance sheet format, as it says in the balance sheet below. And we're going to enter updated amounts after the transactions occur that it tells us into the answer spot, or it's going to be the after this receipt of a bank loan, for instance, what changes in terms of assets, liabilities, and net worth. Okay, so we've got a starting point here, and then we are going to consider the receipt of a bank loan. So it kind of helps to slow down and think about, okay, a bank loan means that we have cash coming in, we've borrowed money, so we have more cash, but now we owe the bank that money back at some point as well. So our liability is going to increase, which is the bank loan liability. So with that said, we can take the $4,300 opening balance, add $5,100 of cash that we will have received for the bank loan. And then we're going to take that $1,900 opening balance there of the loan and also increase that by $5,100. And that brings us to to updated balances for those. Let's see here I think I did. Not 500, 5,100. I thought that looked a little off there. So now we've added 5,100 to cash and 5,100 to our bank loan. None of the other accounts are impacted. So we can just click equals and link all of these here, because we want to get everything input to ensure that our assets still equal our liabilities plus net worth. Student loan, mortgage, and finally our net worth. Awesome. So now we can see 132,500 in assets and 132,500 in liabilities plus net worth, and we're good to go. Okay, let's come down. There's 4 different transactions to consider here. So let's look at number 2. The second transaction indicates that we sold contents of home for the same amount that they were purchased for, $6,800. Okay, and so here we're going to have to consider which accounts are impacted again. When we sell something and we receive the cash for it, right, that's going to drive our cash balance up. And the contents of home is going to decrease because we sold it. We no longer have that, right? So we take our opening balance, $5,600, and we add the $6,800 of cash we receive from selling those contents of home. And then we can let's just focus in on the contents of home. So it began with $6,800, but we sold it for that amount. And so we have nothing left in contents of home when we're done with this transaction. And then again, we'll just fill in the rest of the accounts so that we can get total assets and liabilities and net worth to ensure that we balance out. I'm going to do our little trick of dragging our formula down. Once we link that, we can just drag it. So it's kind of a nice, quick way to update. And then you see 129,800 equals 129,800. We're in balance and we're doing good. Alrighty, let's come down to number 3. So here in number 3, it says we paid $2,000 to reduce an outstanding mortgage payable. This will be the principal portion like we talked about previously. So no interest. It's just reducing the outstanding loan balance. And that's going to be a cash reduction because we're paying it. So our beginning balance of cash was $5,100. So we subtract 2,000. And it's the bank. Sorry, did we have a mortgage? Here it is, mortgage debt. So our beginning mortgage debt was $43,600, and we're going to subtract 2,000 out of that to get 41,600. And those are the only 2 accounts impacted by that transaction. So then we can just link to the other accounts above that were unaffected. We can drag that down for ease of not having to do equals and over again. Either one's fine. If you're more comfortable just putting equals signs for each one yourself without dragging the formula, that's okay. And you can see we're in balance still, and that means we're looking good. Okay, our final transaction, number 4, we bought a boat for $7,600, paying a $1,100 deposit with cash and borrowing $6,500 from the bank. Okay, so this has a few different transactions going on. We bought the boat, and the boat cost us $7,600. So the boat account was 0. I guess I'll do it just to maintain consistency. It was 0 to begin with, our opening balance, plus 7,600. So now it's at 7,600. So now we have a boat on our assets on our balance sheet that's worth 7,600. But we didn't pay all of that with cash. We paid 1,100 of cash. So we'll take our 5,500 opening minus 1,100. So now we have 4,400 in cash, but we borrowed the rest of the amount, 6,500, from the bank. So originally we had a $2,000 bank loan, but now we're adding 6,500 onto that to end up with an $8,500 bank loan after purchasing the boat. And then we'll just, again, link up to all of the accounts that were unaffected by this transaction. Whoop. I am just kind of going through. So here's the alternative way to just, you can, geez, too many equal signs. You can just select each one of these individually if you'd like. And you can see when we finish, our assets equal our liabilities plus net worth. And we can move on to the next problem. All right, in homework problem number 9, we need to indicate whether the account balance will increase, decrease, by how much, so on and so forth. The first transaction, I guess I removed that out of there, but we'll do this together, so that will be fine. And the check, again, is that we really, and you can see that we continuously, time and time again, do this process of ensuring that assets equal liabilities plus net worth. And as we've been sort of alluding to, if assets equal liabilities plus net worth, if 2 things are equal and you subtract one from the other, you get 0 as a result. And so that's with our self-check figure, showing that it should be 0 indicates that our assets equal our liabilities plus net worth. And it's just an easy, quick way to do that on a spreadsheet especially. And if you can see 0, you know you're in balance. And if you don't see 0, then you know maybe you typed the numbers wrong or you're missing something, right? Okay. So let's get started here. Let's just start with our first one. We purchased a new TV for $1,000 on credit. So a TV is something that we own. It is an asset. So our assets will have increased. See, our self-check doesn't go to 0 anymore because we only put the asset side in. but it tells us that we purchased this on credit. So we need to add liabilities to our assets, liabilities, and net worth. And once you do that, you can see that our check figure goes to 0 and we are in balance. Okay, so now on number 1 here, we purchased $87 worth of gas on credit. So it was on credit, so no cash had been paid yet. That's important. What it means is that our liabilities increased, and it is an expense of gas. It's not really technically something we're going to call an asset because it's going to be used up relatively quickly. And so net worth, maybe I'll just put a little comment, parentheses here. Remember, that is our revenues minus our expenses, basically, is how we're going to get to net worth. Or assets minus liabilities, kind of another way to say that. But inherent in the net worth figure is the revenues minus expenses, and expenses are a minus. So just as I mentioned, and we could type this in, I just did you could also do a equals negative, click that cell. So what we're saying is it's a subtraction from net worth. Net worth will decrease due to $87 of gas expense. Okay, we made an $850 bank loan payment. Again, we're going to assume it's a principal payment, and so that reduces our cash asset, and it reduces our liability, our bank loan liability, and we're in balance. Now here's these both are kind of interesting. We purchased a couch for $820 cash, so I'm going to put an equal sign, and I'm going to put a minus first, minus 820 into my formula, indicating that we paid the cash, so our cash asset decreased. But then I'm going to put a plus sign with 820, indicating that our couch asset, a couch is also an asset, cash and a couch, they're both assets, so they're just within this one category. But we have a minus and a plus, and so the overall impact to assets really is nothing, because the cash asset decreased, the couch asset increased, and we've kind of just effectively traded one asset for another, and so you see a 0 result. Similarly, we paid for 3 months, we prepaid 3 months of insurance with $270 of cash, and so that's kind of the same thing here. I'll explain a little bit more here in a moment. So we're going to have minus 270, indicating we reduced our cash asset by 270. And then we increase our prepaid insurance asset by 270, resulting in 0. And when we prepay something like insurance, that insurance is going to last us 3 months out. And so that is the idea where we will consider that an asset, because it has ongoing value to us. And it only becomes an expense after we use up that month by month. And so in this instance, I'll just do a little breakdown. So we have $270 prepaid insurance asset. That represents 3 months. So that means that every month, if we just divide those, we have $90. We're paying for 3 months of insurance at $90, and this will be insurance expense each month once that month is over. And so it tells us here, ask us the next one. We used up one of the 3 months of prepaid insurance. Say we paid for that at January 1st, for example. Maybe now it's January. It's the end of January. And so if once we use up 1 month, it's just that 90. So we subtract 90, and that will be an expense, which will reduce net worth. And that shows up as a negative there. And we're in balance. All right, then we paid interest of $43 in cash on a car loan. So we'll say minus 43. Again, that's an expense. Compare that to the principal payment, was a reduction of liabilities. But interest is just an expense. It doesn't reduce the liability. And finally, we received an internet bill for $999. So when we get a bill in the mail, remember, our debt is showing as it's going up, so our liabilities will increase. But that is for internet services we used this month, essentially, and that is an expense. So we have a reduction to net worth. Oh, I put a 900 here. If you this is where if you type the number in wrong, you'll see your check figure not work. Take out the extra 0. Yep, still wrong. Make that balance. And now you've got all the numbers input correctly. Your check figure lets you confirm that your assets and liabilities and net worth, your accounting equation, is balanced. And you are looking good. Okay, so in our last problem, number 10 here, we have various personal accounting information that was written down. Some of it was destroyed. So we have different things going on here, and we need to calculate how much is this computer worth. You can see it's got a question mark, and what's the balance of the student loan. So that's our task here. So it's kind of we've got to put the puzzle together, if you will. So I think a good first place to start with this problem is just to indicate whether the individual items here are the assets, liabilities, etc. And so let's just go through and classify. So a bicycle is an asset, automobile is an asset, cash is an asset, computer is an asset. We have net worth here. You know, that's just, it is net worth, is net worth. The loan is a liability. Remember, the television is an asset. And then it also shows us total assets. And then down here we have unpaid bills, which is a liability. So just for the heck of it, let's go ahead. I think this is a good way to work on solving our problem, at least. Let's get a starting point. We know that total assets here, as it tells us, individually is 8,120. We don't know what liabilities are. That's kind of the question mark that it shows us. But we do know that net worth is 3,030, because that is basically just given to us in that instance, right? Okay, so that means if we know these three things here, assets, liabilities, net worth, hopefully this has become kind of, in line with every problem we've looked at, is that our fundamental accounting equation tells us that assets equal liabilities plus net worth. So we need to figure out what would we need to add to 3,030 to equal assets, to get us to a place where liabilities equal assets plus, liabilities plus net worth equal assets. Let me write this out as kind of a algebra problem. I think might help us too. So let's do it like this, because I do feel like this problem can be just a little tricky if you don't have it kind of visualized. Okay, so as I mentioned, we have 8,000. I'll just link this here, and then we'll have our equals sign. We don't. This is x. Let's do it like algebra. Solve for x. Liabilities will be x, and then net worth we know is 3,030. So if we want to solve for x, we just need to subtract 3,030 from both sides to isolate the variable there. That gets us, oops, let me just put that in. That equal, then we know that x equals 5,090. So what we're saying is liabilities equal 5,090. And if you're feeling, I just did this as an illustration. If you're comfortable with algebra, you could have just taken assets minus net worth here, and you could basically arrive at the same calculation pretty quickly. And then you could add these together if you really want to ensure, and you can see that the sum of those two equal 8,120. That equals assets, and we're in balance. Okay, so we know a little bit more. We know some information. That doesn't solve our problems quite yet, but that's the information we need to solve these problems, because now we can go through and do some additional calculations to figure out what the assets are and what the what his student loan balance is. Okay, so in order to figure out his computer worth, let's go ahead and just equals. We're going to do equals over to the text here and just identify every one of our our assets. And then we'll just bring amounts over. Now this is the question mark. Maybe I'll call that X, just like we were just doing. Again, they're kind of having us do some algebra. It's really just intended for us to understand the components of the accounting equation. But now we have all of our items that are assets listed here. And we know total assets. It tells us what that is. So we know all of the components except for one, and we know the total. I feel like that format's just a little different there. And so again, we can sort of do a little bit of an algebra technique, right? And so we just need to solve for the missing variable. And if we know that the total equals that, and we're just missing one piece, we can just subtract out all of these other components. I'll add them together just so we get a sum. So 5,180 is all of the assets other than the one that we're looking for. Subtract 5,180, and then you get 2,940. In other words, if you were to put 2,940 in here and then do our auto sum, it should equal the 8,120, and you can see that it does. So essentially, we're just solving for that isolated variable based on kind of detective work, if you will, accounting work there. And that tells us that his computer must be worth 2,940, and we'll put that into our answer. Okay, the last question here, what is the balance of his student loan? We can sort of do a similar exercise here. If we know that total liabilities, let's just write this in, total liabilities. And one thing you might see me doing, so if you have a text or something and you're wanting that column to change size, you see your cursor, how it goes to that black kind of cross with the arrows. You can stretch the column, or you can also just double click on the side and it will expand to fit basically there. Okay, and we know our total liabilities because we calculated that above, and that was 5,090. Let's put a little line there above that. And we need to just say, okay, we know our total. One of the pieces we're looking for is the student loan. And what else do we have? We have unpaid bills as our other liability. So let's just click over to these. We have unpaid bills. Just 2 liabilities as opposed to the 1, 2, 3, 4, 5 assets. One thing you can do here, I'm just going to do it to match our formatting. You can align the text over there. And again, we know what do we know? We know unpaid bills. And we need to solve for X again, basically, which is our final component. And again, basically doing the same type of algebra here. If we know that the total is 5,090 and it's 2,590 plus something is that, then we can just subtract. We can do equals the total minus the other piece of it. Gets us our figure of 2,500, and that's our student loan balance. So this one is kind of a headache, I think, but it is, I don't know, maybe you like doing this. It definitely asks you to do kind of calculation puzzles and algebra to get to these solutions, but it is a worthwhile exercise in reinforcing that idea of the fundamental accounting equation. That's assets equal liabilities plus net worth. And then those totals, assets, liabilities, and net worth, are made up of individual account balances. So it's not something that typically in our normal course of business as accountants that we would be doing something like this. The only reason, that's why they say his information was destroyed. So it is something that you could do if you had to, but really this problem is more so just designed as a math exercise to try and solidify those concepts that we were just talking about. So with that said, that brings us to the end of the homework assignment, and hopefully you found this helpful, and please reach out if you have any questions. All right, thanks everybody. Have a good day.